Hello and welcome to Macros with Mythili, our weekly program where we take a hard look at all the major macroeconomic issues and developments in India and overseas. This week we are extremely privileged to have with us noted economist Dr. Rakesh Mohan. Rakesh is presently Executive Director at the IMF Washington, where he represents India, Sri Lanka, Bangladesh and Bhutan. Prior to that, he was Deputy Governor of the Reserve Bank of India from September 2002 to October 2004 and again from July 2005 to June 2009. In the intervening period, he was Secretary, Department of Economic Affairs, Ministry of Finance, Government of India. He's also held several positions in government, including that of Chief Economic Advisor, Ministry of Finance, Government of India, and has headed a number of committees in the infrastructure arena, notably transport. So who better than Rakesh to help us make sense of the complex macroeconomic scenario, both in India as well as globally? Of course, his views are personal. So he does not represent either the IMF or the Government of India. Welcome to the show, Rakesh. As someone who's kind of worked in the government, worked with the Reserve Bank and now in the IMF, what sense do you make of the global economic scenario as also the domestic macroeconomic scenario?
I think that the current global scenario is much more complex than what we have seen perhaps any time over the last 15 years. So coming from a situation of what we might call the Great Moderation till the crisis in 2008-9, where almost all the world was going in the same direction, that is low inflation, high growth, and so on, followed by an overall downturn. You now have a situation which is somewhat new, where different parts of the world are going in somewhat different directions. That is, the US is on a recovery path, though slow. Europe is still not really on the recovery path, although things have stabilized. Whereas there's a good chance of the US normalizing monetary policy in sometime relatively in the near future. Europe is not expected to go away from very accommodative and loose monetary policy for quite some time. Similarly, Japan is still not recovering despite Abenomics and both monetary and fiscal stimulus. So in terms of the three large economies, they're going in different directions. Similarly, the fourth one, that is China, although it is slowing down, but it is still growing at a reasonable pace. You take your pick, 5%, 6%, 7%, but nonetheless, it's a reasonable growth rate. And one thing I always remind people is that China growing at, say, 7% today is more than China growing at 10% 10 years ago, or even 7 years ago, because 7% of 200 is higher than 10% of 100, and the Chinese economy has clearly doubled in the last 7 years. And because of the Chinese slowdown, particularly the investment slowdown, that the demand for commodities, steel, and of course oil, all these things have slowed down, and as a consequence, good part of Latin America is in difficulty, and also is going to have an impact on Africa, which has otherwise been growing quite handsomely in the last 10, 15 years. So to summarize, the point I made right in the beginning is that we are in a much more complex global economy today, where we can expect a number of headwinds in the coming months, maybe a couple of years. And so macro management in every economy, certainly including ours, is going to be difficult and complex in the months and couple of years to come.
Rakesh, you spoke about large parts of the world which are in trouble. And within India, we have this view that, we are in a much better shape because our GDP is growing, our CAD is under control, fiscal deficit is under control. Now, how valid is this assumption? Does the rest of the world share this very rose-tinted view of India?
I would put it slightly differently, that relative to the rest of the world, we are in a comparatively better position, partly because, first, that because of the commodity price decline and the oil price decline, we are among the biggest gainers in the terms of trade, because we are not really exporters of any commodities. So relative to, say, China or most of Latin America, etc., that we are among the best gainers in terms of trade because of the oil price decline and the commodity price decline. Second, that because we have indeed been correcting some of our macroeconomic imbalances in the last couple of years, that is, our fiscal deficit is basically under control, and in line with the kind of predictions made and the kind of measures taken in the last 2 or 3 budgets. Also, of course, as a consequence, partly as a consequence of the commodity and oil price declines, inflation is under control. But then inflation is under control everywhere in the world. And third, from a position of an excessive current account deficit in 2012 and 2013, it is now at a very reasonable levels, again helped greatly by the oil price fall. Having said that, there's no question that we also facing generalized global trade slowdown. So that clearly affects our economy as well. Second, that we have had somewhat difficult 2 or 3 or 4 years or 5 years, and we are still in the process of coming out of that slowdown. The indicators for private investment are still not as encouraging as one might have seen. And therefore, whereas we are indeed in a better state and a better spot than most of the large economies of the world, we are not out of the woods. And second, because of the factors that I talked about in the global slowdown and the global complexity, that we need to be much more vigilant in terms of global developments, which I would say are more unpredictable today than I would have said a year ago. And so we can't relax. We can't be complacent. Anything can hit at any time. And we know, of course, the capital market volatility in the global economy in the last 2 months is very indicative of that anything can happen in the next few months or years.
Rakesh, you said we need to be vigilant about global developments, and there are 2 major global developments that we really need to be watchful about. One is the Fed, the hike in interest rates by the Fed, and the other is a slowdown in China. Now, which of these 2 developments do you think is likely to be more significant for India, and what are the kind of defenses that we can adopt for both of them?
Ever since the dot-com crash at the turn of the millennium, when US monetary policy went to near zero, the world has essentially been living on monetary stimulus,
steroids, yes.
monetary steroids for the last 15 years. And therefore, as you might expect, if you've had extended zero interest rate policy in the United States, in Europe, in Japan, that coming out of it is not going to be easy. Because given what's happening in Japan and Europe, the US dollar obviously has to then appreciate, and that then damps down inflation and inflation expectations in the United States. So every time that the US Fed breathes about normalizing monetary policy, something happens in the world.
Sure.
We saw that with the taper tantrum in 2013. It's happened in the last couple of months when there was some higher expectation of the Fed doing it in September, this month in a couple of weeks. And you've seen, as I said earlier, things that are unpredictable, that the Chinese stock market had overheated. It had gone up about 120% in about a year, and it had a tumble. And then that tumble caused waves first across Asia, then across Europe, including Wall Street, which none of this was expected, say, 2 months ago. If you read the IMF's World Economic Outlook in April, it certainly did not predict any of this kind of capital market volatility. And therefore, I wouldn't want to say which is more of a problem, the Chinese slowdown or the US normalization. My point, as I've said before also, is look, US monetary normalization has to take place. Whether it's in September, whether it's in December, whether it is next year, that it has to take place. I think that we've learned from the crisis of 2008-9 that rational markets or the financial markets are not rational.
Okay.
And whereas those who say, look, this has already all been priced in, maybe it has. But on the other hand, we shouldn't be surprised if something surprising happens.
Okay, Rakesh, I'll interrupt you there because we'll come back to the kind of defenses India needs to adopt, but after a break. But please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and we've got a very special guest with us here today, Dr. Rakesh Mohan, India's representative at the IMF. Rakesh, before the break, you were talking about how the Fed's, reversal of interest rates and the normalization of the US Fed monetary policy is a given. Now, what are the kind of defenses a country like India can possibly adopt? Is it reserves? Is it forex intervention, raising interest rates? Because some amount of outflow is inevitable, is it not?
Yes, I think so. First, let me say that, let me go on the fiscal side first. That whereas I think that we do need to keep our fisc in order, just so that we continue to have international confidence in the Indian economy, but at the same time, the kind of statements made in the economic survey as well as in the budget, I would vote for even a greater emphasis on domestic public investment in infrastructure, and that of course reflects my own interest and
Absolutely.
work, but also on a more macro basis, that particularly in the context of headwinds from the world, that if we can increase demand in this country, which also has a major growth component, i.e. through investment, given that public sector bank balance sheets as well as private corporate sector balance sheets are currently stressed, the chances of a quick recovery in private investment are low. And therefore, even for the purpose of protecting ourselves from the rest of the world, we need to concentrate even more on public investment and doing faster implementation, faster allocation of resources for public investment in infrastructure, particularly I would say railways, ports, and the continuation of road investment. Because that would do is that it'll increase demand for major products. For example, if you accelerate investment in railways, I understand the Railways Minister announced some acceleration of investment in railways yesterday. That will increase demand for steel, for cement, for labor, and everything else. So that we are much more conscious that domestic demand creation, maintenance is today of even greater importance than normal, given the headwinds of a global trade slowdown. That's number one.
Okay.
Number two, very clearly keep defenses against capital outflows and inflows. Given that Indian forex reserves are much lower than our total debt liability, and of course, they're much lower than our debt plus equity liability.
You're one of the very few people to have brought that to attention, because most people say, look at our reserves, they're close to $355 billion, and very few people actually remember that our net external liabilities are close to that range. So
you're much higher actually, they're about 450 or 490, I forget, but something of that order. And then if you add all the equity investment in the country, the external liability is much higher than our reserves. Therefore, the point I always make is that we need to be opportunistic in terms of our external management. As and when excess flows take place, don't be shy of holding them into reserves, because you might need them in this very uncertain world. Second, I think that the Reserve Bank's sort of time-tested policy of intervening in the forex market to provide stability has shown its value over the last 20 years, I would say. Continue with that. And also, and particularly given the situation of global trade slowdown, we need to keep a competitive exchange rate.
Okay, you spoke
Don't ask me what that exchange rate is, though.
No, that I won't. I know no central banker, ex-central banker also ever wants to comment on exchange rate. But you spoke of the Reserve Bank of India's monetary policy briefly, and there's an issue which is really very contentious at the moment, particularly in the light of the recommendations of the Indian Financial Code and also the composition of the Monetary Policy Committee. What are your views on that, Rakesh?
The global, thoughtful opinion clearly says that to take monetary policy decisions are better than single-person decision-making. Second, we do need, however, to observe the composition of the monetary policy committees in the major central banks of the world. Let me quickly just mention that starting with the US Federal Reserve, it has the chairman of the Federal Reserve plus all the 7 governors. And their 7 governors, as they're called, are equivalent to our deputy governors. And it further includes the vice chairman, the president of of the New York Fed, who's a vice chairman of the Federal Open Markets Committee, plus 4 rotating federal district bank presidents. Note, there is no outsider in that committee. And note that all the chairman and all the governors are present in that committee. But of course, it is about 12-member committee, and it does vote. So there is the advantage of having 12 people deliberating on monetary policy decisions.
And who appoints these people? Is it the government or is it some independent?
This is another issue I think that we've been placing excessive emphasis on government appointing monetary policy committee members. Remember, who appoints the governor and deputy governors? It's the government. Everywhere in the world, the government appoints the governors and deputy governors of central banks.
So how do you ensure independence? And in most places,
monetary policy committees.
How do you ensure independence?
Well, I think that to the extent that I think people's view of the Reserve Bank for at least the last 20 years, if not earlier, there have always been discussion on the Reserve Bank having its own view and doing the policies as the Reserve Bank thinks fit.
Regardless of the appointment?
Regardless of there being an MPC, not being an MPC, regardless, if I may say so, who the finance minister is, regardless who the governor is. I think that if you just scan your own programs, perhaps, the financial newspapers, there's been a continuing controversy of the governor not reducing rates when everyone else wants him to reduce rates. So my point there is that this excessive emphasis on independence, I mean, look, as far as I can see, the governors have been as independent as other governors in the world. I was mentioning other central banks. You take the European Central Bank. The European Central Bank Monetary Policy Committee consists of the president of the European Central Bank, plus all the council members, that is the permanent members, who are like the deputy governors, plus all the central bank, member central bank governors in the European system, monetary system. So again, there's no outsider. Third, take the Bank of England. That has the governor, all the deputy governors, plus the chief economist of the Bank of England, plus 4 so-called external members. I say so-called because once they're appointed, and are appointed by the government, once they're appointed for the 3-year term, they have to be totally internal. They sit inside the Bank of England. There is nothing else that they can do during those 3 years, whether they're academics, whether they're businessmen, they're financial sector people, and they have all of those have been represented, but they become internal for the 3 years, they become monetary policy committee members. So my point that I'm just making is that, look, the main central bank lessons or observations that you can make is that there are monetary policy committees with members ranging from 7 to 8 to 9 to 25 in the case of the European Central Bank. The participation of external people is very limited, and where there is, they become internal for the time they become MPC members.
And just because they've been appointed by the government does not necessarily make them government spokesmen. On that note, we have to slip into another very short break, but please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and we're discussing the intricacies of the global economy, the domestic economy, and a whole host of other things with the Executive Director of India to the IMF, Dr. Rakesh Mohan. Rakesh, I want to now ask you about the NPAs of banks. Now, you've been in the Reserve Bank for a long time, and that was a time when the NPAs were first very high and then came down to very manageable proportions. Now, the current philosophy is to blame public sector banks for all the NPAs, all the ills in the banking system. But are the public sector banks more sinned against than sinning? Is it the ills of the larger economic system, or are they really so lacking in, credit appraisal skills and follow-up skills that we really need to do something about public sector banks?
Well, as you mentioned just now first, that that in the 90s, the public sector banks had very, very high NPAs, and there were all kinds of measures taken through the late 90s, so that by the early 2000s, the NPAs had been reduced very significantly. And then, of course, there was a huge credit growth from 2002 onwards or thereabouts till about 2009, or maybe 2010 actually. So that the NPA proportions of the public sector banks had become not very different from good banks internationally, and certainly the Indian private sector banks. Second, their rate of return on assets, the rate of return on equity had all become of international standard. It's true, however, that since around 2010, deteriorations taken place in most of these measures in public sector banks. So in looking at whether public sector banks have been sinners or they've been sinned against more, you sort of have to answer why they were functioning well during the period they were functioning well and why they are not functioning so well now.
And did ownership have anything to do with that?
Well, that's my point. The second point I would make there is that what did happen, particularly in the last 5-6 years, is that there was this huge emphasis on PPP in infrastructure projects. And to the extent that one observes that the private sector banks didn't do a great deal of lending to infrastructure, you can look at it in two ways. On one hand, you can say, well, it was lucky that we had public sector banks, so that in fact infrastructure investment could take place. On the other hand, you could say that look, because of public sector banks, they could be somewhat jawboned into lending perhaps more than they should have into infrastructure. But then you might have had less infrastructure. And of course, with the economic downturn that has taken place until a year or two ago, that it always happens that when there's a downturn in the economy, it is particularly infrastructure projects that suffer, and that's mainly because they have much higher leverage, they have much higher debt equity ratios. And so I think the real answer to your question will have to come a couple of years from now, unfortunately, when you can actually study, particularly after the economy recovers and some of these NPAs become better as the economy grows and some of the infrastructure projects become good. So in summary, what I'm saying is that the public sector banks' NPA problem, not all of it, but a good proportion of it, has happened because of the emphasis on excessive lending to PPP projects, infrastructure projects, which are typically more leveraged. And so when there's a downturn, they suffer more.
And that brings me to another subject very close to your heart, Rakesh. You also mentioned it, infrastructure. Now, what is the way out as far as infrastructure financing is concerned? Do we go back to term lending institutions? Is the PPP model broke? Does infrastructure financing necessarily have to be done by government? What is your view? Because you've done so many reports on the infrastructure sector, including recently on the railways.
We do need to have PPP, but we need to be much more conscious of where PPP is suitable and where it is not. And conceptually, it's very simple, that where there are commercial rates of return, you can have higher levels of PPP than otherwise. Where the commercial rates of return are low or non-existent, you can't really have PPPs. It's simple to say, of course.
Absolutely.
Practically, which project and so on is a more complex, is a more difficult matter. Second, that one major finding we had in the India Transport Report in the National Transport Development Policy Committee was that right through the 1990s, there was investment, the annual gross domestic capital formation, annual investment in the railways and roads all put together was very similar, around 0.4 to 0.5% of GDP on an annual basis right through the decade 1990s. In the 2000s, mainly as a consequence of the National Highway Development Project, the four-laning of highways, etc., plus the Prime Minister Gram Sadak Yojana, that over the next decade in 2000s, the road investment went up from 1.4% to around 1% of GDP, while the railways remain the same at 0.4%. Therefore, a very simple point that if you want the economy to grow at 7 to 10% a year in the next 20 years, we really have to ramp up railways investment.
Okay.
And it's not so difficult, because if you could do it in roads, which are much more dispersed in the sense of implementation, it's much easier to do it in railways, because you have a whole mammoth organization which is well organized.
Okay.
And so, to my mind, you can really ramp up investment in the railways, particularly concentrating on the dedicated freight corridors and associated investments. Because as you invest in the dedicated freight corridors, you can take freight trains off the main lines. You can then actually invest much more in the passenger transport as well and make it much faster as well. So what I'm saying is that this is not rocket science.
Okay.
You can actually do it.
Okay.
Fortunately, what I find is that the budget numbers of the Railways Minister are about coincident with what I had recommended. I think it is a coincidence. About 1 lakh crores for this year, 8.5 lakh crores for the next 5 years. If you can do that, I think that will give a good stimulus to the economy as a whole. In addition, do much more work on urban infrastructure that is much more complex and difficult, and ports.
Okay, so at least as far as railways is concerned, I think we do have a fairly dynamic railway minister,
Yes.
so I hope he does take your suggestions. But we're almost running out of time, Rakesh. So very quickly, if I can ask you, you've been, you worked in 3 bureaucracies, Government of India, Reserve Bank of India and the IMF.
And
so
the World Bank originally.
And the World Bank also. So now that your term in the IMF comes to an end in November, maybe I can ask you to stick your neck out and say, which of these bureaucracies, 4 bureaucracies, have you enjoyed the most and why?
I think that I would say that I probably enjoy the Reserve Bank the most.
But why?
Central banks have a very interesting mix of effective and influential policy making, which affects the economy as a whole, but based on economic analysis, macroeconomic analysis, and also engagement with the rest of the world. So someone like me, who is in some sense an economist practitioner, that's the best place to be.
Okay.
Where you're actually making policy, influencing things, having some satisfaction of doing something for the country, at the same time having high analytical content in the work that you do.
Clearly, the Reserve Bank of India is where you enjoyed yourself the most. It's very evident because you had 2 stints over there, even though the bureaucracy over there very often can overwhelm you. But thank you so much, Rakesh. It's been great having you. There's so many more issues that one could discuss with you, but I'm afraid we've completely run out of time. Thank you very much for being here with us and sharing your views. Thank you also for watching, but we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.